Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Kramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Looking at like 177-ish, look like the high later in the year around the...
Or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Looking at like 177-ish, look like the high later in the year around the...
And of top line sales growth on a year-over-year basis, up with net GAAP EPS about $4.58. Now, if you compare that to last year for the same quarter, they only earned about $1.88. So we're talking about over 150% top line sales growth relative to over 65% revenue growth. And what you have is a nice stock that is trending to the upside, probably going to get additional upgrades after this earnings call. But the balance sheet certainly makes a big difference as well, because if you look at the market cap, about $5 billion, the company has about $600 million in cash. And so this is another thing that investors are latching onto right now, Nicole. It's cash on the balance sheet as well. They only earn about $1.88. So we're talking about as top line sales in relative to over 65% revenue growth, industry groups that are still in high demand. If we get another infrastructure bill, or if there's any movement towards additional spending from a fiscal standpoint for things like EV markets, or even in the industrial space, perhaps utility companies like Atkore are going to benefit significantly.
Yeah, I think it's very interesting that you noted that maybe some of the analysts may jump on board, and they very well may. A stock that is basically doubled. It's incredible. And by the way, RBC on January 20th, I saw put a buy rating. So they were unafraid to make the call, excuse me, in a big way to say that this had potential. And when you look at a chart, even a somewhat of a near-term chart, you see what a big move this is even right now. So how would you go about trading this?
Yeah, so if we take a look at the stock, I mean, overall, it's been relatively weak considering the market, but I think it's trading much like the S&P and the Dow. which both these indices could certainly see additional downside risks between now and, let's say, the Fed meeting, Nicole. So in this case, we could go out to April, and I think Atkore is really well positioned. It's not necessarily a early stage industry player like some of the growth technology names or even late stage companies, perhaps like financials. I think it's more of a mid-stage based company, and I think that it has quite a bit of room to run associated potentially now with some infrastructure spending, not to mention it really is one of the largest suppliers in the United States. So overall, we can give it some time and, of course, probabilities. One could go out and consider looking at the April call options, looking in the money at about $100 strike, which again is about $7 or $8 worth of intrinsic value. You could purchase that call option for about $14 a share, or about $1,400 per contract. And essentially what you're doing here is looking for the stock to trade above the 114 between now and expiration in April, which gives us plenty of time to let this trade work out. Now, it's a trade that potentially won't work out in the short run, because we could certainly see some consolidation pull back in the markets after we get a nice counter trend rally, which I think we're in right now. But at the same time, it gives us a little bit of breathing room to outpace this weak quarter, at the very least weak January we've had. I think we're going to have a weak quarter overall performance-wise. Maybe in April we'll see things improve, and that's where companies like Atkore might slowly continue to trend to the upside. So again, looking at the $100 call options that a trader could certainly consider purchasing today, we got to take into consider commissions for about $14 a share or $1,400 a contract.
Thank you so much, George. I'm glad you brought this one to us, because now we have a way to trade it, and it certainly has been a name that's had a lot of action of late, too. Looking at Atkore there for our disruptor of the day, George Sillis. Thank you. Coming up next, it's our 360 round. We will preview Pulte's earnings tomorrow, discuss the state of the home builders, what's going on here, home improvement stocks, as well as mortgage rates have been creeping higher, and costs are pretty high, too. Coming up.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparison, select Studies. This also gives you access to hundreds of. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. Built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com. Built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even.
Welcome back to Trading 360. I'm Nicole Petalides. We're focusing on housing in the 360 round because we have Pulte this week. We're watching mortgage rates on the rise. Brian Nagel's with us, Managing Director, Oppenheimer & Company, and Jay McCanless, SVP, Equity Research, Wedbush Securities. Thank you both very much for being with us. So, Jay, I'll start with you as you take a look at the home building group overall, which has sold off a little bit. How are you feeling about the group?
I'm still feeling very positive. We got a good set of earnings from Meritage, which were buy rated on last week. They also talked about how activity has picked up in January, even in spite of some of the mortgage rates moving higher. And then as we look ahead to Pulte tomorrow, we're expecting earnings of $2.33, which is 2 cents ahead of consensus. We're neutral rated on this name, but one of the things we'll look for from them is a read on the baby boomers and the active adult housing, which makes up about 25% of their business. And then also a good read on the move up buyer, which is another 50% of their revenues typically.
Okay, and Brian, your thoughts, because you were saying the threat of higher rates is likely overblown. Explain that.
Sure. So look, I think I'm going to really mirror a lot of what Jay said. But so I follow the home improvement retailers, not necessarily the home builders, but I obviously watch the home builders for read-throughs into my home improvement retailers. And that's exactly right. I think the underpinnings right now of the U.S. housing market are quite good. And I think companies like Home Depot and Lowe's are benefiting from that. As I'm talking to our clients, there's a lot of concern, once again, about the threat of higher rates. I at this point, as I watch this, and I'm no great expert, okay, but as I watch this, I do believe that these threats are once again overblown, given just the underlying strength in the housing market. And even if rates rise, as they have a bit, they're still historically low. And so lending costs for consumers and potential home buyers out there are very, very low at this point.
So, Brian, are you saying that you still like and would buy names like Lowe's and Home Depot and Sherwin-Williams? I mean, these are some of the names in the home improvement world that have done well.
Yeah, so Home Depot and Lowe's are two of our top picks within our consumer coverage. So I very much buy those here. What I'm watching for, I mean, look, this takes a little bit away from the rate discussion. But I guess, the concern I still have is that as the economy pulls out of the COVID crisis, will there be some type of give back on sales? Home Depot and Lowe's capitalized significantly upon pandemic disruptions. We saw sales of those chains inflect very much higher. Mm-hmm. So I am a bit worried about that, but I think the market is now braced well for that potential.
And Jay, your thoughts here as we're awaiting the Pulte numbers. You mentioned Meritage came in. The group overall has seen incredible demand. I mean, it's more been, obviously we've seen a story about supply chain issues and labor and maybe pauses, but the truth of the matter is, as you well know, Jay, is demand is real. They're always looking for somewhere to build. And they just got to get it done, and they seem to be doing okay. Year to date, the group, though, has been beaten down. When you look at this group of names, Jay, what are your thoughts? Are there buys here?
Absolutely. We're, like I said, we're neutral on Pulte, but of the ones that are on the board, we like KB, Lennar, Horton. We have outperform ratings on all three of them. Horton's going to report on Wednesday morning, and I think they, along with the rest of the group, we've heard from a couple of the builders that they have stress tested their backlogs for higher mortgage rates. Meritage talked about it last week. KB talked about it last month. And what they all said is that even if we were to go to a 4 handle from a 3 handle on the 30-year, they feel like it would be a minimal disruption to their backlog. I think one other thing I would point to, if you think about buying versus renting, with the rise that we've seen in both multifamily and single-family rents, still think for sale housing is very competitive versus those other options for shelter.
So when you talk about KB, Lennar, and DR Horton, these names, as you said, still have potential even if rates creep higher. Jay, I just wanted to get a final thought on the group, because when we think about millennials, they're still buying now. They're getting excited about this coast to coast. You have the Sun Belt doing incredibly well. Jay, quick thought.
Yep. And I think that's what we're going to be looking for from Pulte, is confirmation that the baby boomers, who are your typical active adult buyers, are in there buying, along with the millennials and the Gen Zs are also starting to show up. So yeah, we think the demand trends are still very solid.
Yeah, Brian, do you see an improving picture over 2022 as supply chain gets better? What's your final thought, Brian?
Oh, look, I think that's definitely a possibility. I mean, now, I'm going to go back to Home Depot and Lowe's. Those companies have managed very well difficulties in the supply chain. They have a lot of pricing power with consumers. But look, to the extent that supply chains start to flow better, as I think they are starting to now, that would be a positive. To also, I guess this goes, again, I want to pine upon the home builders, but to the extent we start getting better supplies of homes for sales, that should also help as well. Because as I look at a lot of these housing data right now, I think a lot of sales are held back simply because of a lack of supply. And so Home Depot and Lowe's, look, they benefit from the lack of supply, but to the extent we start getting better home sales, they'll benefit from that as well.
Yeah, it's great to chat with you both, and we love the fireplace in the background there, Brian. Looking great. I tell you, thank you both very, very much. Brian Nagel and Jay McCandless, thank you.
Thank you.
Thanks a lot.
Thank you, friends, for joining us here on Trading 360 every single weekday at 11 a.m. Keep it right here. Fast Market is next.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait for it.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Garner suspects to 2010 to 2012, when all assets increased in value at some point, occasionally at ridiculous levels. Even with the Fed taking its foot off the gas pedal, Garner thinks it could take another year or maybe two before we digest all that liquidity that's been created since 2020, which is where this was initiated. Now, let me give you an example. I want you to check out the monthly chart of corn, okay? Corn over the last 20 years. After the financial crisis, we see corn made a run from $3 to $8, all right? Partially fueled by quantitative easing. Garner points out that we saw a similar rally in corn prices last year, followed by a period of consolidation. She thinks corn could be headed for round two of that rally later this year, just like how in 2012 we got round two of the post-financial crisis rally. Of course, some commodities, they've already run. Now, I want you to take a look at this. This is a weekly chart of oil, which is up to $88 a barrel today. Garner notes that crude is already nearing overbought status, and that's the RSI that we look at, okay? The Relative Strength Index. It's an important momentum indicator, which suggests that the upside could be limited at this point. She also sees a potentially powerful ceiling of resistance around $90. Also, when you look at the commodities, the futures trading commissions, the COT report that she showed us, most large speculators are already long here. Historically, that often means we could be approaching a peak because eventually you run out of buyers. In a normal correction, Garner wouldn't be surprised to see oil pulling back to 71. And if it breaks down below that level, it might dip to 62. But again, because of quantitative easing overhang, she wouldn't expect it to get much worse than that. If Garner's right, by the way, that oil's gotten ahead of itself, and that's a bold contrarian call, then think about what would happen. The Fed would be winning its fight against inflation. A big decline in oil prices might translate into fewer rate hikes. That's something that the bears never think about. What else could work here? While Garner thinks oil's gotten ahead of itself, she actually says precious metals like gold and silver could have substantially more room to run. Nobody likes those that I know. That's exactly what we saw in 2010, 2011. Just look at the monthly chart of silver. It never really recovered to anywhere close to those levels. Now, check out the weekly chart of this is the most counterintuitive of all. iShares 20-plus years Treasury Bond ETF. And that's the ticker here is TLT. That's what people all call it, TLT. Right now, Wall Street has gotten pretty darn bearish on bond prices, right? Because lower prices translate to higher bond yields, and that's exactly what you're supposed to get when the Fed is talking about raising interest rates. However, despite this pullback, Garner notes that U.S. Treasuries are still in a long-term bull market, and the TLT is holding up nicely right above a powerful floor of support. That's the floor right there, okay? While Wall Street has already baked in the prospect of several rate hikes here, Garner, she's not convinced. If Jay Powell takes the Janet Yellen approach to tightening, those rate hikes could play out over a course of years, not months, as most investors now seem to expect. Remember, what she's saying is what I was saying at the top, which is you just can't just necessarily think that everything is going to collapse. Again, I want you to go to the history. In 2011, the TLT rallied from 90 to 124, okay? This is a little bit before this, but with the help of quantitative easing. And even with the taper right now, the Fed is still buying treasuries through March. I think Powell doesn't want to get as aggressive as Wall Street's expecting. And in that case, we could see a rally in treasury prices this year as investors realize he's being more measured with his rate hikes, and no one's thinking that. How about the stock market? All right, take a look at this monthly chart of the S&P 500 over the last couple of decades. In the short run, Garner says the S&P still looks like it has room to move lower. Okay, so that's that little break right there. She thinks that's going to happen. But once we work out some of the froth, she thinks there's a good chance we won't have a severe decline this early in the tightening cycle because there's still so much liquidity in the system. Remember, when the Fed started raising rates last time in late 2015, we caught some early volatility, but then the S&P resumed its long march higher. Because we already have seen to priced in several rate hikes in advance, Garner thinks we're headed for a period where bad news for the economy is good news for the stock market because weak economic data means the Fed won't have to raise interest rates as aggressively as we expect. And by the way, when we get weak economic data, what does work? Growth stocks. Again, though, Garner says we could still take a serious short-term hit before things stabilize. Be aware of that. The S&P 500 has a floor of running between 3,900 to 4,000. but that's down at least 11% from where we are now. That's a big hit. Once finally we get that shakeout over, though, she's optimistic that the medium to long-term future for stocks is pretty good. In short, just because the monetary stimulus is over, that doesn't mean commodities and stocks won't continue to be propped up by the increased money supply. The Fed may be tapping the brakes here, but as Garner sees it, we're merely decelerating from an already very fast situation, and we know from the last cycle that the after effects of quantitative easing can linger for years. The bottom line, the charts in the history, as interpreted by Carly Garner, suggest that 2022 could be a strong year for most commodities, the bond market, and even the stock market. Even with the Fed hitting the brakes, she thinks the momentum from the last couple years of money printing will continue to push these asset classes higher, something, frankly, almost no one is predicting. Let's go to Forrest in Florida, please. Forrest.
Hey, Jim, I'm a long-time follower, and I really like the morning meetings.
Oh, thank you. The 1020 with me and with Jeff Marks. I'm glad I want everybody to get in on the club and watch these because we really tell a pretty good story together. What's going on?
Hey, NextEra bounced 8% today, but it's still down 15% on the month. Utilities don't usually act this way. What's going on with NextEra?
Well, I tell you, that is, geez. I mean, I know that a lot of the utilities have been running. I was running Con Ed. I just think that they're doing, they got an EV charging network that we knew from a long time ago. That could be it. But the main thing, I mean, that's a nationwide, they're talking about a hydrogen-fueled network, too. All I know is that this is a fantastic forward-thinking utility that has done a lot of stuff with charging, and it can be bought still. Jay in Wisconsin. Jay.
Booyah, Kramer.
Booyah.
Jay in Milwaukee, Wisconsin, and I was calling about Cortora Energy, CTRA, formerly Cabot Oil and Gas, and I was wondering what your opinion is.
Oh, I like these guys so much.
Before earnings in February.
You can buy it. I like them very, very much. It's a great combination. A really Tom Jordan used to come on the show. We have to get Tom Jordan back on the show. He is a fantastic CEO. You've got a winner there. So anyway, Cortora's a buy right here, right now. If history is any guide, 2022 could be a strong year for most commodities, the bond market, and even the stock market. The charts, as interpreted by Carly Garner, suggest that momentum from the last couple of years of money printing will continue to push these asset classes higher. Now, doesn't that make some sense? Hey, much more Mad Money, including my exclusive with Silvergate Capital. Could a bank with a crypto connection be worth looking at this market? I'm talking to the CEO. Then, this weekend, I opined about the Fed on Twitter, and I'm discussing why I think betting against the Fed chief will continue to be a fool's errand. I'm feeling mighty lonely on that one. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Kramer.
You've seen him in the AM, and you've seen him in the PM. But Kramer's working hard to give you an edge on the market all day, every day.
This is something that we batted around just this very morning when the Charitable Trust Research Director, Jeff Marks, on my new program, The Morning Meeting.
Sign up for the CNBC Investing Club and don't miss an episode of the brand new Morning Meeting.
We want you to be your own portfolio manager, and that's what the club is about.
hey, you're late on all this stuff, so we're just going to kind you where we think it should be because you're behind on inflation. It's going to last longer than you think, and you need to hike 5 times. But that doesn't matter, right? Because the Fed will do what it wants to do. But your take here on that.
Yeah, and I think it's worth noting in the past when the Fed's been going the other way with policy, and by that I mean they've been trying to be more accommodative, loosen things up. They often do use announcements as a way of kind of getting the market to do what they want it to do before they actually go out there and move on rates. And that's not unusual to see in the past. It's also something that was used at the ECB quite often as well when they were trying to loosen policy up. So I think it makes sense that the Fed intentionally went out there and really set the tone that we are going to be tightening policy this year. And I think maybe the market took a look at it and said, if you really are serious about tightening policy, bringing in inflation, you're not doing it with 1 or 2 hikes. You're going to have multiple hikes this year, and one of those might have to be 0.5% versus the usual 0.25%. So it'll be interesting to see what the market is priced in and what actually ends up happening from Fed policy. That's something that unfortunately we won't know until later on in the year.
Yeah, Kev, and to that point, one of the Fed governors, Bostic, was out over the weekend saying, hey, a 50 basis point rate hike is not out of the question. But we've heard this rhetoric before. You've kind of pounded the table on it. The expectations are for 5 or 6 rate hikes this year. But what's your thought here? You see 3 or 4, right?
As I can, so as not to scare the children. A 0.5 point interest rate hike or 7 this year, sold. No chance that they're going to do that. Come on. What is this? Are these people just trying to make headlines? Please. Let's take the L train back from La La Land now. Listen, if I'm Jerome Powell for 30 seconds, and I have to choose between inflation that I think is going to come down the second half of the year or causing a recession, I'm going to choose inflation every single time and live with that, especially since I've been trying to get inflation up to 2% for the last 10 years. I think Jerome Powell sees this differently than most of these analysts that are talking. I think, remember, you have a chance in the wages data this week to get another number lower than last month and more reasonable. If you get that, like the income and outlays number we got on Friday, this market will start to become more comfortable with that. Do I think interest rates are going up this year? Yes, I do. I don't think it's anywhere near the numbers that these people are talking about, Tom. I think given the binary choice between inflation and recession, Jerome Powell's going to choose inflation every time, guys.
Yeah, I read that over the weekend also, Kevin, that, a lot of these, economists and analysts are saying they should shock the market into a recession. I don't understand why anybody would say that, to put that out there. So we'll see if that happens. It's definitely on the table. They'll finish their, their tapering in early March. We'll wait for that March meeting, see what they do. I'm guessing 0.25 points probably on the table. All right, Sean. Let's move to another stock that got upgraded today, and that's Tesla. It's still down about 26% from its all-time highs that we hit late last year, above $1,240 a share, but having a nice little bounce back here. You know what? I look at this. The valuation's still really elevated on Tesla, but it's been hard, to defeat this stock. If you've been a bear, you've just been a loser. But a lot of people are getting opportunities to get in here. What's your take here on Tesla?
Yeah, I mean, this was something that's not unusual for Tesla because there are just some firm believers in that company out there. And when you do see some of these larger pullbacks, it's not unusual that sort of as you keep going down lower and lower, call it $50 increments, you just hear more and more people saying maybe this is a good area to move back in or try and buy some shares here if it's something you've been keeping an eye on. But I mean, it's still getting hit pretty hard. And more and more people are starting to get some more fundamentals, not only to trade Tesla off of as we get more data, people get more comfortable with some of the electric vehicle metrics, but now we actually have more companies out there as well to compare them to that are also making pretty big gains in the electric vehicle world. When Tesla was really the only player out there, you were just trying to come up with some sort of a blended comp of a car company and a tech company, a software company, whatever it might be, to compare them off of. But now we're getting more and more companies out there. If they're not electric vehicle makers themselves, they're getting more into the electric vehicle space, like a GM or Ford, and you can at least get some comparisons for, is this good or is this bad? So it's going to be interesting to see what they do here.
Yeah, they've got production starting to ramp up down there in Texas. They're trying to bring online, the Model Y and the Model 3 over in Germany also, which will increase capacity and sales, Kev. But, a lot of people don't look at technicals and they don't believe in the charts. They're backward looking, Kevin. But this stock firmly bounced off the 200-day moving average late last week, and it now found a base here. Your thoughts here on Tesla real quick?
Yeah, 50-day moving average, about 1,031 is what I have on the Thinkorswim platform. But you're right, Tom. $800 and some change turned out to be a pretty strong level for Tesla and investors. And don't get me wrong, if the overall market was down, Tesla might be down or up less as well. Remember, it's in the S&P, it's in the NASDAQ. So it can't hide from the global, a lot of these names that we're going to talk about, they can't hide from a global sell-off, right? It's very hard to do that. Even Apple sold off with the rest of the market. So, you've got to decipher between why are these stocks going down, why are they going down as much as it is? Well, the whole market just sold off significantly, and then they hit some of the growth stocks a little harder than that. Not really shocking if you look at everything that's going on with interest rates. So, I think this is a good, healthy bounce in Tesla. People starting to pound the table here. Just a good, healthy day. Tesla contributing with the rest of the market, guys.
Yeah, and, pivoting off of that, a lot of competition's coming down the pipeline as far as the EV space goes. GM, you're going to invest over $30 billion into the EV space here moving forward. Sean, they've got earnings tomorrow. This stock's basically flat from a year ago levels, but if you look at it on a 3-year chart, it had a really good 2020 as demand was rapidly rising. Then you run into supply issues. Actual auto sales were only about 17 million last year, but that wasn't due to demand because auto prices and used car prices at all-time highs. Your take here on GM going into earnings, Sean, because I think this is going to be not a controversy, but maybe a little bit more volatility than we typically see in GM going into earnings.
Yeah, and I think it goes right back to what we were saying, where people are still trying to get a good feel for how you put on a valuation or some sort of comparison in this industry. And GM going so hard into the electric vehicle space, even if it's not really making up a huge chunk of the revenue now, if you're looking out into the future, and that is stocks and equities are massive discounting mechanisms for future expectations, you have to really start including that. And people are starting to focus in a little bit more on profitability, what they're doing for sales, how they're doing on cash flow, because the expectation is for them to have to go out there and invest a little bit in getting this business going. And between them and Ford, it is going to be interesting to see which one of these companies really executes the best going into this space. Looking at it though on a chart, if I like to look at volume at given price levels. This is somewhere where you start to see volume trailing off, which on pullbacks maybe can be an indicative sign that maybe some of the sellers are getting exhausted, or that this is just we're getting down towards a valuation level that you need a really particularly bad report for the stock to get knocked lower through. But that could easily happen, especially right now. It doesn't look like investors are going to be very forgiving for companies that are getting hit in terms of profitability in particular.
Yeah, they drew down a lot of debt during the pandemic. They're actually not using debt to finance like another $7 billion in investments on 2 plants in Michigan that they're going to open to handle some of the demand as far as EVs go. But Kevin, this stock in early January hit 19-year highs. Ford hit 20-year highs earlier this month. It's pulled back pretty significantly from over $67 a share. Option market's priced in about a plus or minus $2 move either way. Your thoughts here on GM?
You know, this has been a pretty interesting evolution for this company. I mean, think about, did you realize that over its history, GM has had 43 brands? 43. You know how many they have now? 4. It's Chevy, GMC, Cadillac, and Buick. That's it. That's all they have. Now there's a Hummer coming down the pipeline in the electric space, but what electric cars does for GM, it gives it an opportunity to actually say they're growing again and a growth company. That being said, their PE ratio is small. It's tiny. It's as small as we've reported on this show. It's about, you can make a case it's 7 to 7.5 times next year's earnings. So, you know, this company, certainly from a valuation perspective, is pretty cheap. Can it get cheaper? Of course it can, if the rest of the market sells off. But if you look at it, that 47 level held pretty strong here back from during the summer to now. So, you know, the value, you can actually say that GM's kind of a growth stock that has pretty good valuation. So, you know, obviously people have some scars, both emotional and financial, on GM, but certainly this is a name now in its new form that can brag that it's growing, guys.
Yeah, and they just need to get those models out there in the EV space, start competing, and I think that's the biggest issue for the legacy automakers, is that they don't have enough of the product out there yet as they ramp up, and they're really making a lot of investments. But Sean, when you look at this from a trading perspective, Kevin mentioned it's held that level just below $50 a share that we saw in the summer. It's held that. What do you do when you look at an example trade in GM? Because I'll be honest with you, Kevin, you're probably with me on this. For years, you didn't even really look at GM as a tradable product because they had so many issues.
Yep, and so I think one thing to look at here, and where I'm focusing on, is just some of these price levels we're at, where we're getting down towards some of the lows we've seen over the past year. And you might be asking yourself, you know, if there's some way to play for a moderate recovery in share price, for example, could be one thought that you're looking at, because the bulk of that volume that we did see over the past year went down around that $58 price level. And if you think that might serve at least as some sort of a shorter term magnet for these shares to trade at, then you're just looking for a moderate recovery in price. You're not looking for, say, a grand slam $15 or $20 rip or anything like that. So what I would look at for an example on this one is actually just buying an at-the-money call spread. This is going to be pretty aggressive in an earnings environment. We typically look at going out of the money and selling some premium. But if you're someone who just wants to go right at this and just, for example, get that upside exposure, where as soon as it starts moving higher, based off, you know, volatility and everything sort of doing what you would expect it to do, you can see some pretty quick expansion in the value of these spreads. So I was looking, and this price has moved around a little bit since I did earlier, but I was looking anywhere in the $50 to $51 calls that expired this week as an example of something to buy. And then when I look at where I want to then go out and say sell something on the other side of this to sort of bring down my break even, it's still a defined risk spread. I was looking somewhere around the 52 or 53 price level. And if you're going somewhere around that price level, your break even is going to be close, if in some cases a little bit below where the stock is trading at right now, but then you also have that close to a 1-to-1 risk reward in most cases.
Yeah, so Kev, which spread do you have up here for Sean to look at? Is this a 51, 53? You're looking at $1.08 on that. So it's basically a 1-to-1 risk reward ratio, but that break even about 52.07 is actually below the current share price. So that's why the risk reward doesn't look as great from that perspective. But you'll need less than a 1% move higher for this thing to max out. the risk is what you pay on a $2 wide vertical like this. So, Kev, your thoughts real quick on this this example.
Look at Sean Cruz coming in on a Monday with a good old-fashioned Frankie Walsh in and out trade here to start the week. And Sean, if you're going to be, don't beat yourself up about being aggressive. That's my job, to beat you up, not yourself. So understand that when you look at this, this is just a simple, the nice thing about this is you don't need much of an upside move for you to be profitable. And make no mistake, this is a bullish trade that buys an in the money call, sells an out of the money call, and has a very low threshold to be profitable. But here's the other side. It is a bullish play, and you do need the stock to at least stay here or go higher to be profitable, guys. It does have a little bit of a delta, probably about a 20 delta per spread. Looks like about 5, that means about 100 deltas. So you're getting nice exposure on the upside. Limited downside is the debit you paid. Limited upside, the difference between the two strikes, it's about $1.08. You've got about 92 cents on the upside, guys.
Yeah, and to that note, you know, what you pay is your risk on this. It's basically 1-to-1 risk-reward ratio. If you were just to buy the 51 strike call as a shot to the upside, that's going to cost you about $280 per individual call. So, Sean, reducing, not expecting a big blowout, but you need less than that 1 standard deviation move to get above that 53 strike where you apex in your profitability. 4-day trade, really short term. Great look at a directional type play if that's the way you want to play it. On the downside, it's the same thing. If you want to buy a slightly in the money put vertical, thinking that the shares might go down, you can do that also. But this is definitely a bullish trade that needs a move higher, but not that much. You don't need that much. All right, great stuff as always. That's Sean Cruz. He's a contributor here on the network. But Cav, coming up next after the break, we're going to bring in Andy Swan from Likefolio.com. He's going to discuss the delivery space and UPS ahead of their earnings tomorrow morning. Fast Market. We'll be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hanks. But let's bring in our next guest for our cash tag segment. That's going to be Andy Swan, the co-founder of Likefolio.com. Thanks for joining us, Andy.
Hey, happy Monday.
All right. So we're talking delivery. And I'm guessing, you know, these companies had great holiday shopping seasons, even if there were not a lot of products on the shelves, but people were still getting deliveries. It's dropped off quite a bit as inflationary pressures have picked up. But as far as UPS and this delivery space, what kind of data are you guys seeing at Likefolio?
Yeah, you know, Likefolio is really focused on understanding consumer behavior and consumer insights and really how the consumer is reacting to these companies and to different macro trends. And one of the big, you know, kind of dichotomies that we've seen over the last 90 days has been the increase in the amount of delivery delays. So people talking about their package being delayed, the delivery that they thought they were going to get on Monday now won't be here till Friday. Pretty common theme starting to pop up, 11% more than it was a year ago, and really kind of accelerating. And along with that, a trend showing people talking about shopping online has dropped off 22%. I think the two are very much related. We've seen a competent competition emerge in curbside pickup and really local delivery. So I think consumers are becoming less and less reliant on traditional e-commerce, you know, fast delivery type of methods, and going more and more to the local retailer where they know that they can pull up curbside and get the item that they want, or go into the store really quickly and pick up what they bought online. And so that dichotomy, you know, I think is really very interesting here. And there's pin action all around the economy when you think about that starting to happen, and sort of that shopping online becoming just as much a local phenomenon as it was kind of this nebulous thing that was out there you bought from Amazon. You don't know where it came from, but it showed up at your door. Well, you start figuring that out a little bit when things start getting late, and I think that's what's going on with the consumer. Now, when we dug down into UPS versus FedEx, big rivalry, obviously, both competing a lot of times for the same business, we really see a huge divergence in consumer happiness over the last 90 days. And so this tells me, you know, you got FedEx at 39% happiness level, which is extraordinarily low, and UPS at 59%, which is actually not great itself. A lot of that's those delays, but it looks like UPS definitely did a better job through the holiday season of servicing customers, at least the best they could, with the supply chain stuff going on. So, you know, we see an e-commerce pie shrinking a little bit, and UPS making customers happier than FedEx at least. That's at least a signal to us that UPS could be looking forward to some market share gains over the next year.
You know, Andy, your comments and your data are consistent with the CEO of UPS's comments saying, you know, their theme lately has been better, not bigger. And what they've done, they've gone back to their company and work on things like margins and all the things that make their company within, as it is right now, better without growing. And they're focusing on smaller and medium-sized businesses and healthcare and things like that, and different ways that they can get there. But what's the fundamental thing, in your opinion, or your data, whatever you see? Why is UPS, in your metrics, doing better than FedEx? Is there any reason that sticks out at you other than, hey, you know, their FedEx is kind of poor in happiness, UPS is a little better? Is there anything that's sticking out to Likefolio on this?
Yeah, I really think that it's this delayed shipping. You know, people have gotten really used to getting things exactly when they were told they were going to get them. It was actually, you know, a pretty phenomenal revolution that took place over the last decade, and now you're starting to see for the first time this kind of step backwards. You know, UPS saw on-time shipments at 97% over the Christmas holiday season, which was up from 2020, while FedEx actually fell from 95% in 2020 down to 91% in 2021. So almost 1 in 10 packages sent through FedEx was actually delayed. And so it doesn't take very many of those for the consumer to shift their preference really quickly. You know, could have been FedEx, UPS, I don't really care. But then eventually when 1 out of 10 packages shows up late, you've suddenly got an opinion and a preference between competitors that wasn't there before. We think that's meaningful going forward for both of these companies.
Yeah, and Andy, I know we always think of the delivery space as that duopoly, right, between FedEx and UPS. You had a little bit of DHL in there. They're basically out of the U.S. now. But at the same time, do you see anything in your data that is reflective of Amazon logistically taking more market share and where it's going to be a tripod here soon? Because I know Amazon is investing a lot of money. Do you see any data that's reflective that, hey, maybe Amazon's taking more of FedEx's business, or maybe UPS is fighting off, Amazon? Because I know they both have a lot of business through Amazon.
Yeah, and let's not forget the U.S. Postal Service is also a big player in this. And so, I do think that I actually look at it the other way. I think Amazon sees the threat to their business and to their ability to make customers happy when they rely on these third-party shippers. So the more that they can vertically integrate that, the more that they can control that last mile, probably the better for them. I think that's more of an indictment of FedEx and potentially UPS than it is really, how much Amazon wants to do that. And so for me, the way I think about it is you've kind of got Amazon, as the elephant in the room, and it's verticalizing its delivery mechanisms internally, and then everything else, the Shopify enabled culture, that whole e-commerce section, which is growing very rapidly, small businesses, medium businesses, Etsy, all these relying on these third-party shippers to get things where they want to go. So Amazon can actually create a competitive advantage in the delivery space by taking control of that, whereas those smaller and medium-sized companies don't have any chance of doing that. They have to rely on UPS, FedEx, or the Postal Service. And if FedEx keeps disappointing consumers, it's going to be on those businesses to say, well, we ship via UPS because that's what our customers like. And that's what we think could be the big competitive shift that occurs in 2022 if these stats hold true for the next 90, 180 days.
All right, Andy, before we let you go, I want to dig into that Folio-sized brain and figure out this about these two companies. The operative word that everyone's beating us over the head with during this earnings season is supply chain problems, right? Yep. Are either of these companies having those, or the more interesting question is, could they be part of the solution going forward to supply chain problems and getting packages from off boats and away from ports and things like that and into airports? What are your views on something like that?
Yeah, I think that absolutely they could be part of the solution. They are logistics experts. They're also part of the problem. I mean, when you see 1 out of 10 FedEx shipments delayed, it doesn't give you great confidence that they're going to solve the world's supply chain problems. But I do think that they are logistics experts through and through. They've executed for decades on that promise and done very well. So this might be a blip in the radar. But I'll tell you the other thing that we're also seeing is that these companies, because there's so few of them, there's FedEx, there's UPS, and there's kind of the post office, they really do have some significant pricing power. And so in an inflationary environment, we tend to like companies that have that type of pricing power. And I will say, from what we've seen so far, consumers are willing to accept, and businesses, higher delivery costs if it's on time and if it solves that kind of supply chain problem for them. And so from a margin perspective, I don't think either one of these companies is going to be beat up too badly.
Yeah. They raised, in 2021, they raised prices on average nearly 6% to offset some of those rising costs. But Andy, real quick, while we have you, going into this earnings event, It seems like, consumer sentiment's happier for UPS. They're doing better maybe from that side of it. What kind of score as far as earnings go do you have on this company?
Yeah, UPS, I'd say just as slightly bullish as you can get. FedEx, pretty neutral. There may be an opportunity for a longer term pair trade there. I think I'm more interested in listening to the earnings call and trying to understand and thinking about the pin action that may come off of this in e-commerce and other places than I am really getting excited about betting on either one of these companies for a pure earnings trade.
Yeah, this might be wait for that conference call, because I'm sure there'll be a lot of clarity on the issues that they have. All right, great stuff. As always, Andy, have a great day.
Thanks, you too.
All right, that's Andy Swan, the co-founder of Likefolio.com, joining us, giving us the data on UPS. Now, Kevin, when we look at this one going into earnings, it's pulled back, but not that much from all-time highs. It had a great couple of years due to the pandemic. Really ramped up their business. They're offsetting some of their costs. They're on the rise by raising prices because they do have that ability. So what's your take here going into earnings on UPS?
Tom, if you remember last week, we had a similar feeling about Apple than we do about UPS today. That doesn't mean it's going up. We don't mean that. But in terms of a trade, I'm thinking the same thing about Apple. And so what do I mean? Well, Tom, I'm doing a bullish iron condor in UPS. And here's why, Tom. You're right. It did settle down from this sell-off. The 200-day moving average is about 202, I think. Yeah, 202. The 50-day is 207, Tom. So I'm very cognizant of those two places. So what I did a very aggressive put vertical part of the iron condor in terms of way inside the expected move at 195, 190. But then, for the call side, I went further outside in case it does go through that 200-day moving average through the 50-day.
Investigation.
That the longer this drags on, the worse it is for him, and of course his position is hanging by a thread. I think we're still going to be talking about allegations of partying in Downing Street for some time to come, because yes, you're absolutely right, he does seem to have delayed things, or rather the police have, by announcing, rather to everyone's surprise last week, that there's going to be an investigation by the Metropolitan Police.
John Craig in London. Well, Spotify and Joe Rogan are now both pledging to do more to stop the spread of COVID misinformation as they face backlash. In an Instagram video, Rogan said he'll be more balanced and informed when discussing controversial topics on his program.
It's a strange responsibility to have this many viewers and listeners. I'm not trying to promote misinformation. I'm not trying to be controversial. I've never tried to do anything with this podcast other than just talk to people and have interesting conversations.
Well, Rogan specifically addressed an interview he did last month with Dr. Robert Malone here. He is an infectious disease specialist who claims that people have been, hear this, hypnotized. Into believing that COVID vaccines work and prevent serious disease. Twitter banned him from its platform, but you can still listen to Rogan's interview with Malone on Spotify. In response to the fallout, Spotify just announced it will soon add warnings to all podcasts that include discussions of COVID. In a statement, the company's CEO wrote in part, "We know we have a critical role to play in supporting creator expression while balancing it with the safety of our users. In that role, it is important to me that we don't take on the position of being content censor." The statement came after Neil Young and Joni Mitchell removed their music from Spotify. The music icons protested the platform's support for Rogan. Prince Harry and Meghan say they also raised concerns to Spotify about the dangers of misinformation. The couple, you may know, has signed a multi-year deal to host podcasts exclusively on Spotify. Ashley Carman now, senior reporter for The Verge. She covers podcasting in the audio industry. Ashley, Spotify reportedly paid, I think it's $100 million for the rights to Rogan's podcast. So I guess that's part of the reason he's so important to their business.
Yeah, pretty critical. Spotify makes its money through subscriptions and the ad business, and obviously if you don't pay for